A very warm welcome to you all. This is the chapter, the paper Fundamentals of Accounting, which is the first paper in our CPT. It comes for 60 marks. To do it, we are going to do it chapter wise. The first chapter is Accounting and Introduction. Chapter 1 is having 5 units, so we will do it unit wise. Introduction. Now tell me, what is a river? What is a river?
River is a water which flows.
Very good. River is a flow of water. So what is accounts now? What is accounts? So at one level we can say accounts is tracking the flow of money through the business. How money moves through the business. How it starts with capital, becomes raw material. Raw material, you spend more money, it becomes finished goods. The finished goods are sold and you get back money. This is a trade cycle. So accounts, we can say, is tracking the movement of money through a business. The question is, how life starts in accounts? Now, how did your life start? Maybe it started in hospital, crying. So like that, how life starts in accounts? It starts with what we call with a transaction. Now let us understand, what is a transaction? Transaction is an exchange. You go to a shop and buy something. You give money and it gets exchanged for the goods, say a pen. So transaction is an exchange. Exchange of what? Goods and money. It need not always be goods. Sometimes you go to a doctor. He doesn't sell you medicine. He is only the consultant. He writes a prescription. But what he gives you is service. So do you go to a lawyer or you go to an auditor for audit. He is not selling you anything. He is giving you services. So transaction is an exchange of goods, money and services. Now there are certain rules for transaction. Can you tell me based on the above understanding, can you make some rules for a transaction?
There has to be money involved.
Yes, there has to be money involved. Before that, there has to be two sides. This is called the famous dual aspect. Like how many hands you require to clap? You require 2 hands. So this is what we call in accounts as double entry bookkeeping. Double entry bookkeeping. Very famous. It was invented by Lucio Paciolio. Now there is a second rule for a transaction. It has to be in terms of money. This is the famous money measure concept. Every transaction has to be reduced in terms of money. Now, so if it cannot be reduced in terms of money, it cannot come in our accounts. Accounts is measured in terms of money. So this is the flip side. This is called money measure concept. Now, are there any things which cannot be measured in terms of money? Say example, skill of workers, loyalty of workers, skill of management. You can pay the workers, but the loyalty aspect cannot be measured. Cannot be measured. So now we move to event. We saw what is a transaction. Transaction is an exchange of goods, money, services. Now event is a number of transactions make an event. A transaction is one-off. Like only one time, rent is paid for the month. You purchase goods. It is one-off. You pay the money, you get the goods. You pay the rent and that's over. But what is an event? An event is as a result of a number of transactions. It sits on top of a number of transactions. Like what? Every year you buy, sell. Let us take for example, we are a very big saree shop. We buy a number of sarees, we keep selling. Every purchase, every sale is an transaction. But the end result, end of the year, you have closing stock. So closing stock is not a transaction, it is an event. Please understand, an event sits on top of a number of transactions. So too, profit for the year. Profit for the year is a transaction or an event? Event. It is an event. The entire balance sheet, in fact, is an event because it is the final result of the entire year's transactions, entire year's operations. Now we get into what is called the accounting cycle. It starts with a transaction. The first starting point is a transaction. All these transactions have to be recorded in a place called journal. In accounts, life starts with transaction. Transaction is an exchange. That transaction, in terms of money and following dual aspect, have to be recorded in a journal. So what is a journal? It's a book of original entry. It is also known as secondary book. We will come back to, there's a separate unit on books of accounts. It will come back to secondary book, and it consists of 5 columns. This is asked in our CPT exam. How many columns a journal has? There you don't have time to count, just learn off. It has got 5 columns. The next step in the accounting cycle. The first step is transaction, gets recorded in journal, then it moves to ledger. So from journal, the transactions are posted in the ledger. This was also asked in CPT. What is the name of the movement of a transaction from journal to ledger? It is called posting. Then all entries in journal are posted in ledger. Ledger is known as the principal book. So the definition of a principal book is that which supplies its balances to the trial balance. A journal doesn't supply its balances to the trial balance. So it is called a secondary book. This fellow gives to the trial balance, so it's called a principal book, and it consists of 8 columns. So the accounting cycle, the next step is trial balance. We started with transaction. Transactions were recorded in journal to ledger. So now we know we have made a number of entries in the ledger. To check the mathematical accuracy, we have to prepare what is called trial balance. So from ledger, the balances are extracted. So it's called trial balance. It is a statement. It shows only one thing. The function of a trial balance is to display only the arithmetical accuracy. So now in the trial balance, there are different types of accounts sitting. Now you imagine what business we are doing. Let us imagine we are doing a very big textile business. So what is an account first? At one level we can say, what is an account? At one level we can say an account is something which was money before. Now it has become stock. Now it has become furniture. That money has become building, let us say. So that's an account. So there are basically, to start with, 3 types of accounts. First is called real account, nominal account, personal account. Then a 4th type we will see later, representative personal account. Okay, example of a real account is land. Another example is building. Then plant and machinery. And cash. Cash is also real. So there are some rules for a real account. How do you know an account is real? Anything you can touch, feel, see is real account. Feel, see, touch, if it follows that, it is a real account. Then with real account alone we cannot run a business. We require to pay salaries, wages, electricity bill, we have to make purchases, we have to make sales. So that is called nominal. So one simple rule for a nominal account is, if it is either income or expenditure, if the transaction is resulting in any income inflow or outflow, income or expenditure, then there is every likelihood it being a nominal account. How do you know an account is real? You can feel, see and touch, but income and expenditure is a nominal account. To whom all this belongs to? It is the personal account. It is the owner. The owner's capital is called the personal account. Then also the owner's drawings, bank account, sundry debtors, sundry creditors are example of personal accounts. So in accounting cycle, there are three types of accounts. Each type of account is having a golden rule. So the real account, the golden rule is debit what comes in, credit what goes out. Till your CA final, you have to remember this. In fact, lifelong you will remember. Next, in nominal account, the golden rule is debit all expenses and losses, credit all incomes and gains. In personal account, the famous golden rule is debit the receiver, credit the giver. Please, each and every one of you, it must be in your subconscious, not by heart. It must be part and parcel of your soul. So continuing accounting cycle, we are the types of accounts. So the fourth type of account is called representative personal account. Till now we saw the three types of accounts: real, nominal, personal. How do you know an account is real? You can feel, see and touch. How do you know an account is nominal? Income and expense. Third is the personal, whom all this belongs to, the personal. Now we come to a fourth type, representative personal account. Example is all unpaid expenses, prepaid expense. Example, we did not pay the salaries. So this unpaid salary will appear in the liability side of the balance sheet. It represents the workers to whom we have to pay salary. So it's a representative personal account. It's also prepaid rent. We have paid rent in advance to the landlord. So as though the landlord is now a debtor to us. So rent itself is a nominal account, but rent paid in advance is a representative account. You shouldn't get confused. Salary, wages are of course nominal account, but unpaid salary, unpaid wages are representative personal accounts. Sometimes in our exam they're asking example, they're saying instead of representative personal account, in short it may be said personal account. So don't get confused. So the final step in accounting cycle, the last step is final accounts. So from trial balance, all nominal accounts are closed and transferred to trading P&L. The real and personal accounts are not closed but only balanced and entered in the balance sheet. The preparation of trading P&L and balance sheet is called final accounts. Actually you can say the preparation of profit and loss account and balance sheet is final accounts. It is the last step in the accounting process. That process which started from transaction, entered in journal following dual aspect and money measure concept. From journal gets posted to ledger. Ledger, the balances are extracted to check the accuracy in trial balance. From trial balance, real and personal accounts move to balance sheet. Nominal accounts are closed and transferred to trading P&L. Now the question is asked, why is this partiality? Why do you close nominal accounts? Why don't you close real and personal? Now parents are having two children, let us say. Suppose one child gets a big chocolate. The second child also gets a chocolate but slightly smaller one. Will the second child agree? No, definitely no. So why this partiality between three accounts? Why can you tell me why we are closing nominal? Why we are not closing real and personal?
Because real and personal are continuing entities.
Very good. Now you paid the electricity bill for this month. Next month can we run our shop without paying the current bill? No. Without paying salaries will our people come? Without paying rent will the landlord agree? No. But we have a car in the business. 31st March, the last day of the year has come and gone. Still we can continue to use the car. So too the sundry debtors, sundry creditors, the bank loan, bank deposits, they all continue. So real and personal continue. Nominal accounts are closed because their work is over. So this is the final step in the accounting cycle, that is called final accounts. Now accounting cycle, little more is there. In big companies, final accounts are published as annual reports. They are called, the name is annual report. Annual report of Tata Limited, Tata Steel. Annual report of ITC Limited, like that. The total set consists of this annual report. The complete set is trading account, P&L, balance sheet, cash flow, and also cash flow and notes to accounts. And notes to accounts. What is this cash flow? See, we said that accounts at one level is tracking the movement of cash through the business. So how it came, how much came through the business, how much came because of financing activity, how much money came because of investing activity. This later on in your PCC level you will study in great detail. Just know the complete set of accounts called financial statements or annual reports or final accounts consists of trading, P&L, balance sheet, cash flow, and also notes to accounts. That's way, have a look at the complete thing, what we have done till now. What we have studied is the accounting cycle. It starts with an exchange. An exchange is called a transaction. And that exchange in terms of money and with the two sides. The two sides are called a debit side and a credit side. Following dual aspect and in money measure is recorded in journal. Journal, the movement, next movement is ledger. Ledger, all the balances are extracted to trial balance. From the trial balance, the nominal accounts are moved to trading or P&L account. The real and personal accounts are moved to balance sheet. This put together is called final accounts. Very nice chart. दुनिया तो गोल है, ऐसा ही है. So till now we saw introduction to accounts, the accounting cycle. Now we will get into our units. Unit 1, chapter 1 is called meaning and scope of accounting. Definition. There is a famous definition of accounting. Accounting is the art of recording. Where do you record? You record in journal. Classifying. Where do you classify? You classify it in ledger. And summarizing. Where do we summarize? In trial balance, P&L and balance sheet. So we can say accounting is the art of recording, classifying, summarizing. How? In a significant manner. This concept we will see a little later. It's called materiality concept. In a significant manner means all important things have to come. And in terms of money. In terms of money is what?
Money measure.
Very good, excellent. The money measure concept. What? Transactions and events, which are in part at least of a financial character, and interpreting the results thereof. The accounting work is interpreting the result. That's where a CA comes in. This definition was given by the Committee of Terminology of AICPA. AICPA, American Institute of Certified Public Accountants. It's a very, very famous definition. So we get into the procedural aspects of accounting. So it consists of two steps. First, generating the financial information. Then we have to use the information so generated. How do you generate financial information? By recording, classifying, summarizing the transactions and events. Then these gets to be used. How do you use it? You analyze it, interpret the results, and you communicate it. So these are the two steps in the procedure of accounting. You generate the information, and then you use it.